Imagine checking your phone before work and seeing silver has dropped more than $60 from its recent high. Your stomach drops with it. Maybe you bought silver a few months ago, feeling confident, feeling smart, feeling like you finally understood something the rest of the market was missing. And now the number on the screen makes you question everything. That is exactly where a lot of silver investors found themselves this week. But here is what almost nobody is talking about. This drop did not happen because silver suddenly became less valuable. It happened because of a chain of events most people are not connecting. And one of those events is still unfolding right now, this week, in a way that could completely change the next few months for silver, gold, and your entire portfolio. Before we go further, if you find this kind of grounded, no hype market breakdown useful, take a second to like this video and subscribe to Smart OG John AG. It genuinely helps more people find honest, educational content instead of the sensational headlines that dominate financial media. And it helps this channel keep making videos like this one. So let's talk about what actually happened. Silver had been on one of the most dramatic runs in its history. Earlier this year, prices pushed into territory many long-time silver investors never expected to see in their lifetime. Naturally, after a move that fast and that large, some kind of pullback was almost inevitable. Markets rarely move in a straight line forever. But the size of this recent pullback surprised even experienced traders, and the reason has less to do with silver itself and more to do with geopolitics, oil, and interest rate expectations colliding all at once. Here's what most investors never realize. Silver is not just a precious metal that people buy when they're scared. It is also an industrial metal, used heavily in solar panels, electronics, and increasingly in artificial intelligence infrastructure. That dual identity means silver often reacts to two very different forces at the same time. Sometimes it behaves like gold, a safe haven asset people run toward during uncertainty. Other times it behaves like an industrial commodity, sensitive to economic growth, energy prices, and manufacturing demand. This week, both of those forces were pulling in different directions, and that tension is a big part of why the price action looked so confusing. Let's set the scene. Tensions escalated overseas involving Iran, and headlines about renewed military action sent oil prices sharply higher. Now you might be wondering, why would oil prices affect silver? But here's the part that changes everything. When oil prices spike quickly, it raises concerns about inflation. Higher energy costs tend to ripple through the entire economy, from shipping to manufacturing to the price of everyday goods. And when inflation concerns rise, many market participants start pricing in the possibility that the Federal Reserve may need to raise interest rates instead of cutting them. This matters enormously for silver and gold because both are non-yielding assets. That simply means they don't pay you interest or dividends just for holding them. When interest rates rise, or when the market expects them to rise, assets like government bonds or savings accounts suddenly look more attractive by comparison, since they offer a guaranteed return. Precious metals, on the other hand, only offer potential price appreciation. So when rate hike expectations increase, some investors rotate out of silver and gold in the short term, and that selling pressure can accelerate a price decline that already started for other reasons. There's another reason the market may be reacting this way. The US dollar plays a massive role in commodity pricing. Silver and gold are typically priced in dollars around the world. When the dollar strengthens, it often becomes more expensive for buyers using other currencies to purchase silver, which can reduce demand and pressure prices lower. When the dollar weakens, the opposite tends to happen. This week, shifting expectations around Federal Reserve policy have been pushing the dollar around in both directions, adding yet another layer of volatility on top of everything else. Now here's where things become really interesting. All of this is happening in the same week that the Federal Reserve released minutes from its most recent policy meeting. These minutes are essentially detailed notes from the private discussion Fed officials had about interest rates, inflation, and the broader economy. Investors study these minutes closely because they offer clues about what the Fed might do next, even though they rarely contain a clear, direct answer. Markets have been adjusting the odds of a future rate hike almost daily based on new information, And that back-and-forth uncertainty is a major reason silver has been swinging so sharply in short periods of time. Let's pause for a moment and think about this the way an experienced investor would, rather than the way headlines want you to think about it. Most headlines focus on one story, usually the scariest one, while the real signal may be somewhere else entirely. The scary headline this week was the size of the dollar drop in silver's price. But the more important signal, the one seasoned investors actually watch, is what's happening underneath that price movement. Is this a change in silver's long-term fundamentals, or is this short-term positioning based on shifting interest rate expectations and geopolitical headlines? Historically, sharp pullbacks driven by macro uncertainty, rather than a change in actual supply and demand, have often proven to be temporary rather than permanent shifts in an asset's long-term trajectory. That doesn't mean prices will bounce back immediately, and it doesn't mean they will bounce back at all. But it does mean the reason behind a drop matters just as much as the size of the drop itself. Let's bring this back to something relatable. Picture a retiree named Linda. She spent years building a modest position in physical silver as part of her long-term saving strategy, viewed as a way to protect purchasing power against inflation over time. When she saw silver drop sharply this week, her first instinct was panic. She wondered if she made a mistake. But when she looked closer, she realized the drop wasn't about silver losing its usefulness or its scarcity. It was about short-term shifts in interest rate expectations and a geopolitical headline that could change again within days. That doesn't guarantee her silver will rise again soon, but it does help her separate short-term noise from long-term reasoning, which is exactly the kind of thinking that helps investors avoid emotional decisions. This is where market psychology becomes just as important as market mechanics. Historically, some of the most costly investing mistakes happen not because someone chose a bad asset, but because they reacted emotionally to short-term volatility. Fear can push people to sell during a dip, locking in losses right before a potential recovery. Greed can push people to buy aggressively at the top, right before a correction. Neither emotion is wrong to feel. They're human. But recognizing them and pausing before acting on them is often what separates disciplined long-term investors from those who get shaken out of positions at exactly the wrong moment. Later, we'll look at one market signal that many investors completely overlook, something that often matters more than the daily headlines. Let's talk about gold for a moment, since it often moves alongside silver, but not always in perfect sync. Gold tends to be viewed more purely as a safe haven, while silver carries that added industrial demand component we mentioned earlier. During periods of geopolitical stress, gold sometimes holds up slightly better than silver, precisely because industrial demand fears can weigh on silver even while safe haven demand supports gold. This week offered a good example of that dynamic, with the relationship between the two metals shifting slightly as different narratives took turns dominating the headlines. Watching how gold and silver move in relation to each other, rather than looking at either one in isolation, is one of those quiet indicators that many casual investors skip right past. There's another indicator that could change how you see today's market, and it's simpler than most people expect. It's the difference between short-term futures pricing and physical demand for actual bars and coins. When paper markets, meaning futures and financial products tied to silver's price, move sharply in one direction, but physical demand for real silver remains steady or even increases, that divergence often tells a very different story than the headline price alone. Retail demand for silver coins and bars has remained historically resilient during past pullbacks, according to industry reporting, even when short-term prices dropped. That doesn't predict what happens next, but it does suggest that many long-term holders view price drops differently than short-term traders do. One chart often tells a very different story than the headlines. If you zoom out and look at silver's price over the past year instead of the past week, the picture looks completely different from what a single scary headline suggests. Zooming out is one of the simplest habits an investor can build, and it is remarkably underused. Most people who panic during a pullback are looking at a chart zoomed in so closely that normal volatility looks like a crisis. Let's talk about risk honestly, because responsible investing means acknowledging uncertainty rather than pretending to have all the answers. Silver can be volatile. It has experienced significant price swings throughout history, in both directions. Anyone holding silver, whether physically or through an ETF, meaning an exchange-traded fund that tracks the metal's price without requiring you to store it yourself, should understand that short-term price swings are part of the territory. Historically, some of silver's biggest long-term gains have followed periods of sharp short-term pain, but that pattern is not guaranteed to repeat, and past performance never guarantees future results. The market often rewards those who understand this difference between short-term noise and long-term positioning. That doesn't mean ignoring risk. It means understanding what kind of risk you're taking. Are you holding silver as a short-term trade, hoping to catch quick price swings? Or are you holding it as a long-term store of value, meant to protect your purchasing power over years or even decades? Those two approaches require completely different mindsets, different position sizes, and different emotional expectations. A lot of the anxiety investors feel during weeks like this one comes from mismatching their strategy with their mindset, treating a long-term holding like a short-term trade, or vice versa. What happens next may surprise you, mainly because nobody can say for certain. Markets are currently pricing in a meaningful probability of a Federal Reserve rate hike later this year, a shift that would have seemed unlikely to many analysts just a few months earlier. If that expectation continues to build, it could keep pressure on precious metals in the near term. But if inflation data cools, or if geopolitical tensions ease, that narrative could shift again just as quickly. This is precisely why balanced language matters so much when discussing markets. Nobody can honestly tell you silver will definitely rise or definitely fall from here. What we can say is that multiple forces, inflation expectations, interest rate policy, the dollar, and geopolitical developments are all interacting in ways that historically have created both risk and opportunity for patient, informed investors. Let's bring together what we've covered, because there's a lot here worth remembering. Silver's recent drop wasn't a random event or a sign that silver has lost its value as an asset. It was the result of overlapping forces, rising oil prices tied to geopolitical tension, shifting expectations around Federal Reserve policy, and changes in the strength of the US dollar, all colliding in the same short window of time. Understanding why prices move gives you something far more valuable than trying to predict exactly where they'll go next. It gives you the ability to stay calm, stay rational, and make decisions based on your own goals rather than headlines designed to grab your attention. If you're someone who owns silver or gold, or you're thinking about starting a position, the most useful habit you can build isn't watching the price every hour. It's understanding the difference between short-term volatility and long-term fundamentals, checking in periodically rather than obsessively, and reminding yourself why you made the decision in the first place. Many experienced investors journal their original reasoning for a position specifically so that during volatile weeks like this one, they can look back and ask whether anything has actually changed, or whether it's just the price that moved while the underlying reasons remain the same. I'm curious, what's your current outlook on silver after everything we've covered today? Do you think this week's drop is a short-term reaction to headlines, or do you see it as the start of something bigger? If you already own gold or silver, how are you approaching this current environment, holding steady, adding on the dip, or waiting for more clarity? Drop your thoughts in the comments. This channel exists because of conversations like that, and I genuinely read through them. If today's breakdown helped you see this week's silver drop with a little more clarity, consider sharing it with a friend or family member who's also trying to make sense of the markets right now. Financial education spreads best when people who care about getting it right pass it along to each other. Markets will always produce dramatic headlines. Prices will always swing more sharply than feels comfortable in the moment. But history has shown again and again that patience, education, and a clear understanding of why prices move tend to serve investors far better than reacting emotionally to a single week's news. Whatever you decide to do with silver, gold, or any part of your portfolio, make sure it's based on your own research, your own goals, and your own comfort with risk, not on fear from a headline or excitement from a rally. Thank you for spending this time with Smart OG John AG. Stay patient, stay curious, and keep learning, because the investors who understand the story behind the price are usually the ones who make it through the noisy weeks like this one in the best position.